Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of September the 5th, 2016. Now as we come out of summer trade here, we're going back into normal trade September through December. We're going to start off probably with some volatility. Now what we want to look at this week is the non-farm payroll number. We have the release here. The key numbers that I want everybody to look at here is in August of 2015, we can see that we were 10.3, and in August of 2016, we were 9.7. The U6 number looks at the entire unemployment report, where the U3 is more of a, it is the official rate, but it's just more of a headline number. Where with the U6, we look at the total unemployed plus all persons marginally attached to the labor force, plus total employment, plus total employed part-time for economic reasons. Now, this is a very important report here because it's going to trigger whether or not the Fed is going to raise rates in September or not. I don't think they will. I think 9.6 is the best we've seen. In my respectful opinion, the Fed probably, again, missed the boat here, and they should have raised, if they were going to raise early, they should have done it, in my respectful opinion, in June, but they didn't. So we're hearing rhetoric out of the Jackson Hole. They're talking, they are talking some strong language only a week ago that the Fed is in line to start hiking. So we'll see how this one plays out, but right now, what we need to be concerned about coming out of summer trade and going into regular trade was the unemployment report bad enough, that it would really send the US dollar lower? I would say that there's a 50% chance of that. It's all in how the market interprets the report, not the report itself, but the interpretation of it. So in my respectful opinion, only again, the report was not terrific, but it was not horrible either. So, it was never my opinion that they were going to hike in September. They may or they may not, but I think December is going to be in the cards. So right now, where does that leave us? With the dollar index, we can see that we are still in that range, and in order for this range to break, we would have needed a number above 180K and some upward revisions, and maybe a drop in the unemployment down to 4.8. We didn't get any of that here, guys. So what we're looking at going forward here is the key VantagePoint level to start the week is 95.50, the 18-day predicted moving average. We have a triple EMA cross that's taken place, but again, a lot of this was dependent on that unemployment report. Our indicators are very mixed, and my biggest concern here is this very powerful proprietary indicator from VantagePoint, the medium-term predicted difference crossing over the long-term predicted difference. This is telling me that the medium-term trend is weakening against the long-term. So in this particular case, we can see we're rising up off of this area that I've talked about last week, right on the lower part of this Brexit. We've moved higher, but we're not holding on to that strength. So that is potentially a concern here. So regrettably, I would say that looking at these indicators, that there's a better than 50% chance that we will remain locked in the current range that we've been in for basically since the latter part of June, which is identified by that Brexit bar. So the dollar has not been able to break below the low point of that Brexit bar, but it hasn't been able to break above it for any length of time either. So it's going to take stronger unemployment report numbers, stronger economic numbers in general to help push the US dollar higher. So for now, we look to the additional indicators here from VantagePoint. The predicted MACD has crossed the trigger, but we're below the zero line. Our predicted RSI remains at 61.5. That is suggesting a potential trending move. Now, what it's going to take to get this moving is a weaker ECB. It's going to take commodity prices moving lower, and I'm not convinced at this particular time that that's going to happen. But if we look at the overall unemployment situation since last year at this time, we are doing better, but not fantastic here. It's a very, very slow recovery. So not surprisingly, the equity markets like the idea that the weaker unemployment number means the Fed is probably not going to hike in September, so it should buy a little bit more time on the equity side for further longs. But the S&P 500 is absolutely struggling just under this 2100 mark. So we can see this by drawing a very easy line in here. Our order flow guys are going to come in here. Some of your hedge funds, they're still selling up here just under the 2200 mark. And again, a very, very flat signal here from VantagePoint. We're not showing a lot of momentum to the upside here. It would take a break of 2200 to actually get this trade going. The same as the DAX 30. The DAX is holding on to its gains, but it's basically feeding off that weaker euro. The correlation is 100% between the DAX and the euro. Basically, the DAX goes higher, the euro goes lower. That's how it works here, guys. So with the euro going lower, it's basically made that it's holding the DAX up. Now, we're not guaranteed actually that the euro is going to continue to move lower next week, so that could put some downward pressure on the DAX. Now, the same would apply, believe it or not, to the Nikkei 225. If we look at that Brexit bar, the issue that I'm having here is that the majority of these gains on the Nikkei has been based around US dollar strength. Now, when the markets are globally connected like this, the Nikkei is feeding off that dollar strength and basically forcing the weaker Japanese yen. This could violently reverse here, guys. If the equities turn lower, the yen will strengthen. That's what we want to watch here. When we look at our Forex trading, our major players here, guys, the dollar, the pound, the euro, the yen. These are your main players in the currency market. So they all are tied globally to the equity markets also. And this is something we don't want to lose sight on. So right now, we've broken above the 17,000 mark. The key level here from VantagePoint now comes in at 16,708. That is the critical level that we need to hold above if the dollar yen is going to continue to move higher. Now, as we look at some of our two major commodities we want to be looking at in our Forex trading is, of course, oil and gold. Now, in last week's Forex Weekly Outlook, I've talked extensively about oil, that I did not feel that it would move higher last week, that it would move lower, based on the fact that we're coming out of summer driving season. We've got basically a buy the rumors, sell the fact on the dollar index. And strike three for oil was the equities were a little bit soft here for the better part of the week. So all of those intermarket correlations come together to push oil down, but that doesn't mean that oil is going to continue lower. Our key VantagePoint level now is 45.65. Now on a for the start of the week, we could see a weaker dollar. If we see that weaker dollar in holiday thin markets on Monday, because the Canadian and US markets are closed on Monday, then we could see oil rise back towards, potentially even the 48 level. But my optimism on further strength in oil remains heavily guarded, because ultimately the Fed is going to have to hike here, guys. So right now we want to look at those key indicators on the VantagePoint software, and I'm watching it very, very closely for that same indicator here, and I'm looking for the medium-term strength to weaken against the long-term strength. Now, our predicted MACD crossing the zero line here on our RSI at 31.4, it's still telling me we have further in the medium to longer term, we still have further downside on oil, and the upside is likely going to be capped anywhere under $50 a barrel. Now, the same would apply here to gold here, but remember last week here, guys, that I also talked about this level down here, gold, once again, needs the Fed to basically say they are not hiking anytime soon. That's probably the only way we're going to break above this Brexit area here at 1360. My line's a little bit off, excuse me, there, about 1368, 1370. Once we break above that and hold above that, then gold would be able to say, okay, we're going to move considerably higher. But ultimately, I don't think that that's what's going to happen here. I think that ultimately gold is going to move lower on dollar strength as we start moving towards December. So we may see a short-term opportunity to buy gold, but in the medium and the longer term, gold is unlikely to move much above 1400 if we can even get to that level. Now, when we go into our major currency pairs here, again, a very tricky start to the week because the Canadian and US markets are closed. So when we look at this, we have to basically be able to identify some critical levels here. Now, looking at the VantagePoint software, 111.94, our 18-day predicted EMA, this is an important level, guys. So if we hold below this for the better part of the week, then shorts are back on the table. But if we can't hold under the 112, 111.94 area, then the euro is probably going to break higher. Now, once again, I've got my medium-term strength, my medium-term predicted difference weakening. So my medium-term strength indicator is weakening against the longer term, telling me that basically, if nothing else, we're going to have a corrective move higher. So if the euro is really going to break out of this downtrend, it has to get above 114.50 or the 115 level. Right now, guys, we continue to play in this range, this Brexit range between 109 and 114.50. Nothing has changed there. Our predicted MACD is down. The position of the predicted RSI heavily being influenced by basically what everybody anticipated would be a better non-farm payroll number. And again, it's not that it's a horrible number, it's just not what the market expected. We expect more from the US, the biggest economy in the world, arguably, which is the US. So when I look at all this, put everything together here, guys, basically the euro is probably going to remain sideways with a slight upward bias. And the same for US Swiss franc. It's going to remain sideways, but with probably a slight downward bias here next week. Now, the reason I say that is, again, you can see I've got the bar from the Brexit vote here. Very little has changed here. We've come up, we've had a false break up, we've moved back lower, then back into this exact same area, then a double bottom exactly on that Brexit bottom of that bar, and then we've rallied from 95 all the way up to 99, basically above 400 pips. A great move. Now, our key vantage point level here comes in at 97.58, guys. This is the area you want to watch very closely to start the week, okay? So again, that 97.58 is going to be a determining factor. If we can hold above this level, then the dollar index is going to see further strength. However, my optimism on that at this particular time remains guarded. But again, looking at the commentary from the Jackson Hole, the Fed was very hawkish. So was Fisher, Yellen. They were all hawkish on a potential rate hike. So the market could move away from the unemployment report on Friday and go back to the comments from Jackson Hole. That would support further dollar strength. But I don't think we're going to see that till probably Tuesday, Wednesday, Thursday of next week, with the holiday on Monday. So be careful of this one. But again, guys, I always look for that needle in the haystack. And once again, there it is right there. The medium-term predicted difference crossing over the long-term predicted difference. So basically, it's once again telling me that the uptrend that this pair has been in is weakening against the longer-term trend. So once again, guys, be very cautious with this pair. It is 100% correlated to the dollar index. Now, as we come into the British pound for next week, there's a very mild biased higher. Right now, the pound looks pretty decent for a move higher here. When we look at our critical levels, I want to bring them in here. We're pushing above that Brexit bottom, which was a very significant level. Our key vantage point level for next week starts off at 131.47. We've closed at 132.90. A very big close here, guys. So that tells me we're going to see probably, and we're having very, very good economic data coming out of the UK. Once again, I applaud the UK for exiting the European Union. I think I would have done the same thing. I really didn't see a whole lot of reasons why they should stay in there, to be perfectly honest, but they've made the decision. They're gone. Their economic numbers are not showing the kind of negativity that a lot of analysts said it would. So for now, things the situation in the UK is absolutely improving. Our indicators are all hovering just above the zero line, our predicted short, medium, and long-term differences. Our predicted MACD is challenging the zero level, and we're at 68.6 on the predicted RSI. So it does look like we have potentially further upside here. But what I want to do is make sure we just look at where we've been on this pair. We have a lot of activity. I believe we will move towards this 135 level, but it's going to take some pretty good data out of the UK to push this thing above 135. In my respectful opinion, we are likely going to fail at 135, and the British pound US dollar will resume its very powerful downtrend. Now, as we move into the dollar-yen pair, this is going to be, again, a very tricky trade for next week here, guys. This is 100% correlated to the Nikkei 225. Nikkei 225 it goes up, dollar yen goes up. So if you're a trader of the dollar yen, you need to be watching that Nikkei. Even if you don't have a live chart, you can Google the chart, get the intraday levels, see if it's having a good day or a bad day. But if the Nikkei is going higher, that's what it's going to take to push the dollar yen higher. Now, case in point, once again here, guys, these very powerful indicators from VantagePoint, the medium-term predicted difference against the long-term predicted difference is saying that the trend up is weakening. Now, that doesn't surprise me based on that unemployment report. Now, our predicted RSI is at 82.1. Not a favorable area for longs here for me, guys. We can see that the last time we were up at this level from VantagePoint right here on the predicted RSI, we capped out here and then we fell from 107 all the way down to 99. Now, I don't think we're going to fall that hard, but I do think we're going to have a corrective move down to the critical VantagePoint levels for next week. Now, the 18-day predicted EMA comes in at 102.05. That is the area here, guys, that you must watch. I believe we are going to test that area relatively early in the week, probably by, I suspect, Wednesday, Thursday of next week. If this level holds, then we will see the dollar rise. But if this level does not hold, then basically that brings the 99 level back onto this Brexit bar bottom. It brings that back into play here. So be very cautious around these. And again, take note of the indicators that I'm using in VantagePoint, the medium-term predicted difference, and the fact that we are heavily overbought on the predicted RSI. Now, just because something's overbought doesn't mean it's going to move lower. Let me clarify that. So it's simply reason for concern. So when the medium-term predicted difference is crossing down, we're becoming heavily overbought on that predicted RSI. It's reason to be concerned to just jump in here on long trades. And again, I believe we will have that corrective move by probably midweek. Now, as we come into our commodity currencies here for next week, one of my favorite pairs, the USCAD, is traded on pretty much a regular basis. The 18-day predicted EMA, not a surprise that the Canadian dollar gained a little bit of ground against its US counterpart on Friday based on that weaker jobs number, but nothing is changing the economy here, guys, in Canada. The economy is not doing well. It's a commodity-based economy. Commodities are down pretty much across the board, particularly oil, so it keeps pressure on the Canadian dollar to the downside. So when I look at our critical levels here, we are closing below the VantagePoint 18-day predicted EMA. We're closing at 129.84, but we have a very significant trend line that's coming in at about the 129 area. Longs are still favored here, guys, despite some of our indicators. I think that the move lower on the US-Canadian pair will be nothing but, it would simply be corrective in nature. Now, when I look at that medium-term difference crossing the long-term predicted difference, once again, VantagePoint gave me about a 3-day warning that despite the fact that the US dollar was very strong, their proprietary indicators said that the Canadian pair is even though it's moving up aggressively, the trend is not as strong as what it appears. This is a fantastic indicator to look at. Now I'm just going to draw it here again so everybody can see it. Very important that I point this out because often when I talk about predicted differences, nobody knows what I'm talking about. So when I look at this signal here, that pink line crossing over that blue line, our neural index down, our strength indicator losing momentum, and our predicted RSI right here turning lower from overbought territory. So this is a case when an overbought signal really does work well here, guys. Okay, so for next week, 130.05 is the critical level. Can we retake the 130 level and stay above that level? If we can, then we are going higher. But ultimately, as we move towards year end, guys, make no mistake, the US CAD is absolutely going to struggle to the downside. Any move lower, real money is absolutely buyers of this. Okay, so the worst case scenario, we go down to 127 next week. I think that's highly unlikely. I think your buyers will come in on this particular trend line right here, and I'll be watching the VantagePoint indicators to confirm that. So for now, buying on dips to 129.20 is a reasonable play looking at the longer term indicators from VantagePoint. Now, Aussie US again is still showing the Aussie currency is certainly resilient. I'll give it that. We're starting to pause here yet again. This 76.50 level that I keep talking about, the top of that Brexit vote, we're turning higher yet again. The key vantage point level, 75.74. We've closed at 75.68, just slightly below that level. So if we retake 75.74 to start the week, buying on dips to this level is reasonable, but only if the commodities start to show signs of life. Gold has to move higher, silver, iron ore, even oil. We need it moving higher. If oil is moving higher, Aussie US is moving higher, USCAD's moving lower, New Zealand US is moving higher. So these intermarket correlations are absolutely critical. Now our short-term indicators, our neural index, our strength indicator, and our predicted short-term difference are all saying in the short term we are moving higher, but the medium and long term still a little bit conflicted here, guys. Okay, so we're at 37.7 on the predicted RSI. Things look good for a corrective move, but we have to get above this Brexit high bar here at 76.50. We get above that, we hold above that, we should see a return back up over the 77 level, but ultimately the Aussie is going to struggle like the other commodity currencies, in my respectful opinion. Now, what we're going to do here is we're going to look at our final commodity currency, which is the New Zealand pair, the Kiwi. Pretty strong support coming in here just above 72. Our key vantage point level 72.44. This is absolutely a huge level here right now, 72.44, and this trend line right here. Now Aussie has been trying to break free and clear of this Brexit high bar for basically 3 months, guys. The better part of June, July, and now all of August, and we've poked above here on several occasions, but indisputably we have had 11 to 12 failures at this particular bar, this random level. So the market's watching it very closely. Now, if the dollar comes under pressure next week, it should push the New Zealand higher. But again, if the market simply disregards that one August labor report, which is notoriously volatile, and says, you know what, we've already heard from the central bankers, Fisher, Yellen, they're talking rate hike here, potentially in September, then the market could continue to buy US dollars. So we have to be cautious of that. Right now, a preferred strategy that has worked with my own direct clients here for months is basically selling anywhere above 73 with stops over the 74 level. The highest we've got is on this particular bar right here. Now I'm going to bring that in so everybody can see it, and that's on this particular single bar of a single day based on that weaker US data. And then the market immediately returned lower. So, but again, this is a very tight wedge formation here that we have to respect. When this wedge breaks, we are going to see a much bigger move on New Zealand, but New Zealand's done better in 2016, like I've talked about over the last several months, but it's still struggling here, guys. So we have to be very cautious. For next week, again, holiday Monday, we're going to see a lot of volatility probably on Wednesday, Thursday of next week. So you want to really limit your trade to start the week on Monday and Tuesday.